Hey, my name's James Nicholson. Welcome to my YouTube channel. In this video, I want to talk about a property update. What are the expectations for house price growth in 2026? Well, I've got that update right here for you. And it really is going to be different in different regions throughout the UK. And a lot of this is impacted by what happened in the budget a few weeks ago. So before we jump into this, if you're new around here and you haven't done already, do make sure you subscribe to the channel over there and hit that bell notification. By subscribing, you'll get all the latest house price news, interest rate news, property investing tips, and much, much more. Let's also get some views on this video. Your part in that is simple. All you need to do is smash like, tickle like, do something to that like button. That really helps with the YouTube algorithm, and that really has helped the channel grow. So thanks to everyone that does that. So, what is going on? Well, this is a report by Hamptons, and I know when anyone sees Savills or Hamptons or Knight Frank also do reports, a lot of people say these guys would be biased. But I don't think this data is particularly biased, because when you hear what I'm about to say, you'll see that Hamptons, or you may know or may not, Hamptons sell higher end properties. They're not very favourable at what they expect with those top end properties that they sell. It's actually the lower end of the market where they think things will vastly improve in 2026. And that does make logical sense. And so what they're talking about here is the fact that there is going to be a big north-south divide in 2026. And a lot of that is caused by things like stamp duty and the mansion tax as well, because those things aren't helping with selling properties. So, since 2010, and 2010 is a key date because that's when the market bottomed out. You see, in 2008, we had the financial crisis, but it didn't drop and bottom out for a couple of years later. It actually took 2 whole years to see that bottom out. Now, since then, London has really rocketed. And so since 2010, London is up 84% on average. Now, the rest of the UK hasn't quite done as well, but it's still up 74%, which we'll take. But yeah, London has outperformed, and we've seen that. I mean, the last few years, we've had so many foreign investors that were buying up anything that they could in London. And since then, things have slowed down. More recently, those foreign investors aren't in London anymore. And a lot of people feel that London is just at a price where it's just not affordable for people to invest. But what Hamptons are saying is that now they expect the rest of the UK to start catching up and London to stay pretty flat and stay where it is. So what are they saying? Well, they are saying that by 2026, this is what we can expect in various regions. So London, they're saying next year will be flat, zero growth. Now, you're still going to have higher inflation next year as well. I'm sure it's going to be at least 3% average for the year. So in real terms, that means London property is dropping next year. So that's interesting that they're saying that, considering London is their biggest market for Hamptons. What about the rest of the UK? Well, they're saying that the northeast will be very strong, and that would have 4.5% increase in 2026. I think I could agree with that, because the northeast, regardless what happens, if we go into a recession or we have difficulties, there is still really good affordability in lots of areas in the northeast. That, look, you can get a property with 2 times your annual salary, so it doesn't need to crash down there. Now, transaction volume might slow down. That's something that very realistically could stay low in 2026. But I don't think house prices need to massively move in order to get that market moving in the northeast. And so they feel it will continue moving. That's good for me. I've got property in Doncaster, so happy days there. Yorkshire as a whole, which is part of the northeast, but Yorkshire as a whole, such a big place, obviously, will also do very well next year. And so they predict 4% increase in Yorkshire. Now, where else have they got? The West Midlands They think that's going to be a strong area for capital appreciation as well, at 3.5%. So all of these areas, apart from London, are higher than what we're expecting the inflation outlook to be next year. We're not expecting inflation to be as high as it has been this year, but we'll see. Time will obviously tell. So that's interesting. Northwest is expecting 3.5% as well. No, sorry, 3% increase in the Northwest. Scotland is expecting another strong year of 3% growth as well. And one place that I have the majority of my portfolio that's not looking particularly great is the Southeast. And so the Southeast, they're expecting to go up by 0.5%. So look, that's all right. It's gone up a little bit. But in real terms, that means house prices have gone down. Obviously, inflation is going to be higher than 0.5% for sure. So that's positive for people that want affordability to improve. But also, it's positive because we don't want people to go into negative equity. What would be better for everybody is that prices just didn't go up for 3 or 4 years. People got pay rises, they caught their breath, and affordability also improves because interest rates dropped as well. That would be the better way for things to pan out, because if you do that way, then you're not going to have so much pain for a lot of people. We don't want a 2008 crash. That isn't something that benefits anyone, because the whole market goes pear-shaped then, and that impacts lots of jobs and the economy as well. They're saying that the average for the whole of the UK next year will be 2.5%. So yeah, I think that is achievable next year. So that's interesting to see what they say. I think it's important to look at these kind of things. Obviously, they've put some data into that and they've looked at what they feel will happen. And as I said, I don't think it's as biased as you might think, because Hampton's market is London, it is the Southeast. So they're saying that they're not expecting massive growth there. Here's something that they also said as well. They're saying that properties above 2 million, they believe that they're going to drop by 5%. And that's based off this mansion tax. They think that those properties are going to be less desirable, less people are going to be looking for those types of properties for a little while. And they're also blaming stamp duty, the massive increase in stamp duty that we saw that happened last year, or this year, even in April. That's subduing the market as well. And they're saying, look, the average for London is going to be flat. That means the cheaper properties are probably going to go up a little bit, but the bigger properties, you should be looking at a 5% cut. So I think that that's a fairly balanced view from Hamptons, because that's their market. So they're saying their market isn't going to be strong and price cuts will be there. Let me know what you think about this in the comments below. I know people think these things are a little biased and people have ulterior motives, but they're saying their products aren't going to be that strong this year. So it'd be interesting to know what you think. Do smash like, do subscribe, and also check out all the other content as well on the channel, including this video right here.